2375, go ahead.
They said the roof was for podcast or something. Is that what we heard?
Yeah, that's affirmative.
Good morning and welcome back to the VIP seat. We have a very special guest today talking about capital markets and business aviation. Sit back, buckle up, and let's take off.
Well, Jesse, we have a super exciting guest today. This is the M&A gong. For those that don't know, we ring it anytime anybody transacts. And so we have maybe one of the most influential people in the M&A gong ringing, Nick Fazioli from Jefferies. Nick, thanks for coming on the show.
Absolutely. My pleasure. It's good to see you guys and appreciate you having me.
Yeah, I think when I first met Nick, someone introduced him to me as it's our industry's banker, and you've got to know him. So, Nick, I'd love for you to, tell us about your background, just for those who don't follow, Wall Street and the investment banking side, so they can understand a little more.
Yeah, no, happy to do it. And yeah, I've been extremely fortunate to get to be a very active participant in this particular subsector of the broader aviation market. And it kind of happened over, you get involved in one thing, you get involved in the next thing. So yeah, from a title standpoint, I'm the global head of aerospace and aviation banking, investment banking for Jefferies. For those of you who don't know, Jefferies, we are what we like to call a pure play investment bank on a global level. We're based in New York. I'm based in New York, just over 8,000 employees now. But I head our aerospace and aviation vertical in particular. And so that does have a wider, sort of addressable market than just business aviation. We advise clients in commercial aerospace, leasing, the whole MRO and supply chain across, BizAv and commercial. And the product base is really everything. One of the best things about being at a firm like Jefferies is we're not just a debt specialist or just an M&A shop. We really are kind of full service. So we can do everything from M&A, buy side and sell side. We can raise capital that is debt, that is equity, public and private, that is hybrid, and if things go off the rails on the other side, we have a very strong restructuring practice as well, which does happen from time to time. So, I do nothing but this industry. And then, sort of at the firm, we have product specialists in all the different areas. And, the business aviation side, and we'll talk about it a little bit, is not really historically been a very large part of Wall Street landscape, although that's changing rapidly. And we've been very fortunate to be a part of a lot of that. But our practice, probably in any given year, I would say over half of what we do is involved in this sector, which is, from a share standpoint, much higher than I think most other firms. So I've been at the firm 16 years. Prior to that, I had a career at Delta Airlines, kind of grew up in the commercial world, so wasn't really familiar with the BizAv world until I got to Jefferies, and was very fortunate to, when I first landed there, to get synced up with Kenny Dichter when he was running Marquis Jet, right about the time of their exit to NetJets, and we were fortunate enough to be part of that transaction. And candidly, that kind of gave me my start in this sector, and kind of one thing led to another, and it happened to coincide with real pickup in investment for this space. So it's super fun, great people, very very interesting landscape.
So you've seen the arc from no one was in business aviation to now a lot more people being in it.
Yeah, 100%. I mean, from a Wall Street standpoint, most people look at are like people who sit in my seat who are industry specialists. It's usually kind of A&D, right? Like aerospace and defense, and to some extent aerospace, defense, government. Like those are like the typical kind of monikers, or like the main kind of buckets. And aerospace really just historically meant largely commercial. It's basically like the commercial airline supply system and the maintenance system and the manufacturing and all of that. And, maybe you would have some companies that made things for Gulfstream as they did for Boeing, but it was really a commercial aerospace play. And, I've been at Jefferies now 16 years, that has really kind of come about where all of a sudden BizAv within that kind of aerospace category really has a life of its own. You have some very, very big companies, very large transactions, household name, institutional investors, and even some public market activity in that world. So, once there's a couple of good investments in the space and the sort of the herd starts to follow along and get known, it becomes more of a thing. So that's probably been the biggest change in my 16 years, is just watching our sector grow up. And it's been great to watch, because when you're in my seat, right, as my wife often tells me, like, she's like, well, you don't run the companies and you don't actually invest the money into the companies. She's kind of like, what do you do here? Type of question. And, at Jefferies, we're kind of facilitators, right? There's institutional capital and investors that are looking to deploy money to work into the private and public markets. And my job is to go out and bring great companies, whether they're public, private, founder owned, whatever, to them and sort of bring it. So for us, it's very fulfilling to see, this type of activity build up around a sector that was once a little bit of a cottage industry.
Yeah, I think a good place to start might be kind of piggybacking off that is, what is the macro attitude towards BizAv right now? So it's 2020, end of first quarter 2026. There's been, there's a couple of publicly traded companies out there, but just I'd say like general sentiment towards our section of the industry.
Yeah, and I'll speak broadly, but the groups that I typically speak for, just to clarify, and probably the largest and most active group that we deal with would be what I would call the private equity community, whether that's real private equity funds, family offices, or, there's kind of different variations of it. But so let's just say companies that firms that make investments into companies either for control or for growth. You have your debt investors, right, which are investing in a different side of the capital structure. And those can be in just sort of private debt deals or, asset backed like you grew up in, or publicly syndicated debt. And then there's the public markets, which are obviously institutional investors, typically investing in listed companies. So there's different variations of sentiment or deal activity across all of them. But I would say we went through, so when I started back in, just to like step back for a minute, when I started with this at Jefferies in 2010, which is about the time of the marquee transaction, you still kind of had a universe from a Wall Street eye. Now, keep in mind, there are very big companies that are out there that just maybe haven't hit, the radar that I live in. But you kind of had like the NetJets name that was out there under Berkshire. You had, sort of Flexes, which were, again, very big companies, but sort of largely privately, closely held, and some institutional investment in like the FBO landscape, et cetera. But kind of leading up out of really like the 08-09 financial crisis and like Jetgate, when all the guys went down to Washington in their jets, and it caused like this whole, terrible image for our industry. You started to see a real buildup of, if you just take the charter operator side, like, some big capital and big investment and big growth going into, let's just say, alternatives to whole aircraft ownership, right? And you saw that group kind of build up significantly. And then kind of with it came, a lot of the MRO and FBO activity. So started to get some real momentum. There were, at that time, maybe people coming across with like innovative or different ideas or kind of maybe disruptive ways to try to play that space. And frankly, the capital markets and institutional investor activity across all these were quite available. I mean, we raised a tremendous amount of capital for a lot of your household names, your Vistas, your Flexes, your Wheels Up, during that period. And then obviously we kind of led up to COVID, which, absent a couple months where we were all scared to death about everything, BizAv kind of took an entire different plane, as we all know, right? And commercial kind of went down. And we saw a ton of activity. Those were actually some of the craziest times, we had during that, because particularly the strategics were making a lot of investments out of necessity, meaning, people that had sort of guaranteed to their customers that they could provide lift at a certain price and availability. And all of a sudden their universe of sub-charter operators were, either their prices were out of control or there was no availability. So there was this mad dash to come back in and acquire lift and pilots and fleet as fast as humanly possible to satisfy, their rapidly growing business. And then
perfect time to sell a charter company.
It was a very perfect time to sell a charter company. And, it was extremely busy times for us doing a lot of that. And there were certain people that, just kind of had to have those assets. And, it worked out, in some cases it worked out well for both sides. And some cases it worked out well for, one side and things had to work itself through. But now we're actually in like a really good time now, because I think now but then, so the other side of that trade though was, unfortunately, no one knew what normal was. And that's actually one of the worst things from a Wall Street perspective, is when you don't actually know what normal is, because you either have buyers and sellers with very different views of valuations, because they see things one world. Other people are like, hey, when you see the big hockey stick earnings and growth, like everyone's like, do I really want to, kind of step into that? So for a period, it actually then became a little difficult. And we had this in like the air cargo space too, right? Where everything was getting flown around because the logistics and supply chains were kind of in a mess. And, all these, kind of air cargo companies had the same thing. Was we couldn't find normal. And that's really not good for my business. So now we've sort of just seen this kind of leveling out, I would say, almost like post maybe 2022 or 2023, like things normaled out. There wasn't such a frenzy amongst the big, what I call like the branded charter operators. So like, I got to have Lyft, I got to have this, like everything kind of got back to normal. And I think what comes out of that now is people just say, okay, we went from like kind of a cottage industry through, some of these companies are really gaining scale, both on the operator side and the supply chain side, to like a crazy burst that then reset. But what it reset as, it was just like a fundamental shift up and then back on a different trajectory, right? Because there was a real benefit to COVID in the sense that a lot of people, whether it's corporates, wealthy individuals, what have you, sort of out of necessity started consuming the product and started realizing that there's some real utility to this. And I think that just, again, we just had a step change in like the size of the market and the acceptance, both from a customer and investment standpoint. So now we're actually in like quite a good place. A lot of the activity on the certain sectors of the market have picked up, and then others have kind of cooled off, particularly like the charter management. And we can talk about that a little bit, but I would say we're in like a fairly stable, investable environment. There's been a lot of deal activity, capital raising, control M&A, and such, and some really, really big assets kind of, trading hands or taking in investments. It's good.
And it feels like it's more, at least from my view, more infrastructure, the MRO, the FBO with physical space producing things versus, the charter frenzy that was happening.
Yeah, as a general matter, and that's always the case. Like if you parallel that to like the like the commercial aerospace, it's the same thing, right? Because you have a huge universe that for years and years before any of this BizAv stuff was on the map, manufacturers of components and aerostructures and avionics and electronics, right? Like feeding Boeing and Airbus in that example, the MRO space, fueling, ground handling, airport, just kind of the whole, that has a much wider TAM of investors that sort of are used to and comfortable with that, whether it's private equity, debt, or public markets. But the airline space, if you want to make the analogy, the people that actually operate the aircraft and have pilots and operations and unions and all this type of stuff, like that's actually a thinner group of people that, especially in the private equity world, that kind of play in that space. So like you're always going to see a disproportionate ratio to the supply side, because to some extent you don't have to pick the winners so much, right? Like especially in the infrastructure, like at the FBO, like if you control the FBO at, name your key airport, like whether it's NetJets, FlexJet, individual Part 91 operate, you kind of win either way, which is why investors love that space. But no doubt, particularly from a private equity side, the MRO supply chain, FBO, related, even like some softwares and services and other things have really become like very popular investments. And the good news is like, it's just viewed as a sector that is an industrial sector that has above average growth trends to it. And another thing that people often forget, it's a very US story. So sometimes when there's like screwy geopolitical situations or a little bit unsure environments or currency things, like the BizAv sector is a lot more US based than commercial aerospace. You have a lot less dynamics about, well, how's China going to react to, Boeing if they have tensions with the US, for example, right? Like in our case, we don't have that as much here. So in some cases, when that dynamic is going on in the world, BizAv also looks better as long as people believe in kind of North America.
And less concentration. I mean, there's more competitive ability than these large airlines, and everything's down to Boeing or an Airbus. Like, we've got more OEMs, we've got more competitors.
Yes, exactly right. And then the biggest fundamental shift that we have going on that benefits, I think, the charter, you guys tell me too, but like the charter operator managers, and to some extent the MROs and the FBO, is not only is the just overall pie growing around business aviation, but also there's a shift going on of whole aircraft ownership to sort of other ways to consume the product into like these big companies that frankly have found a more efficient way to utilize assets and still provide a great service. So like, you kind of have growth within growth a little bit, to the extent that you're in the business of either servicing or operating as a fractional or a big branded charter or a manager. That's been one of the biggest changes, right? Is just there's a lot of other ways in like owning your own whole aircraft and your own flight department and all that type of stuff. And that, there are puts and takes of who wins and loses in those dynamics. But I think that's been something that is sort of well understood in Wall Street and people are big believers in.
Yeah, I think that makes sense. I mean, you look at fractional, and it's the only thing that's growing, year over year post COVID. It's the only one that's on a significant growth trajectory. Part 91 traditional charter or traditional flight department is on a net decline, as is branded charter, just kind of at a macro level. And I think that your point about picks and shovel businesses, right? So like the MROs, the FBOs, is like, you don't have to pick, the next winner of fractional or the next winner of charter. It's like, you kind of win regardless, as long as that macro trend just keeps going up.
Yeah. And you're regulated, right? Like what's like, we were lucky enough to represent, Westar Aviation, right? In their latest transaction, and sale to the Greenbrier Equity Group. Like, one of the things that investors loved about that business, one, big, large scale independent, right? So they're not tied specifically to any, just Gulfstream or just Embraer. I mean, obviously they have their concentration, but it's a very diversified from that standpoint. But also too, it's regulated, right? So back to your point of like, listen, a lot of this stuff is calendar driven. You don't have a choice, right? It's either time driven, calendar driven, but like, frankly, a lot of it is calendar driven in their business. Those are the type of things. And it's why private equity and debt particularly loves aerospace and defense broadly, is there's a perceived kind of higher barrier from a competitive standpoint and a predictability to it. It's why you see, Standard Aero, right? That's one of the names that touches our sector in a big way, that has gone public in the last couple of years. Like, those engines are on cycle driven maintenance programs. Like, you can't, as long as those aircraft are flying, they're going to be maintained, right? And the costs keep escalating and going up, and inflation and such like that. So I think, if you take an FBO analogy, it's the fact that you kind of have your barriers and long-term leases on the airport. That's like their X factor, and why that sector has become so popular, particularly with infrastructure funds. And then the MROs within largely the private equity community, but some in the public equity community, just that regulated, kind of nature to it. And not, again, most commercial MROs that we deal with, a lot of them have big exposure because to certain customers, because there's only a handful of airlines in the world. There's such scale. You don't have that in the BizAv world in the same way, right? So like, private equity investors don't like to see 40% of your revenue coming from one customer that could pull a contract at any time.
It is time for us to talk about our sponsor this season on the VIPC podcast, ABJ Jets. We are currently on their Challenger 3500, which is owned and operated, so not managed. They don't have any managed fleet. It's all owned by the company, which means they're going to say yes when you book their flights.
Yeah, and I think a lot of people, I found a Grand View Aviation. We did the same thing. We owned and operated our fleet, and they were like, "What, are you crazy?" I'm like, "I want to deliver good customer service and the best quality product that I can." And the only way you can do that is if you have full control of the aircraft. They spec'd out the whole interior. There's no weird, my owner likes this weird gold thing in the bathroom. Like, it's made for charter clients. It's beautiful. It has all the specs that you need, but also having control of availability, having control of what's in service and what's not. Like, that is so huge for brokers.
Yeah, exactly. And when it's owned and operated, they also staff their team 24/7. So not only is it owned and operated, but somebody answers the phone when you call.
Yeah.
So you kind of have two sides of an awesome operator for brokers. I have some broker friends who asked me to give employees at AB Jets hugs when they found out that I was going to be here because they love them so much. So owned and operated fleet, brand new Challenger 3500, which is crazy. The only owned and operated supplemental lift or 135 charter only aircraft available on the market. So thanks AB Jet for your sponsorship and your partnership this season of the VIPC podcast.
So something I'm curious about, because this happened, when we did our exit, one of the things that's happening is the aircraft values are trending so much higher than they used to. The value just continues to
Yeah.
climb. And even when we sold, even after putting thousands of hours on assets, the assets were worth more than when we purchased them. So, I mean, do charter operators still have that like in their belt? Because it seems like values just continue to go higher and higher.
Yeah, no, I think it is. It gives so for like a So take the debt side of the equation, which for most operators is usually almost like 60 to 70% of your total capitalization, if you will, just like the way these things kind of work out. Strong or growing asset value, give you really good kind of access to capital against your assets. So usually what most people do, right? And Preston, like you live in this world, like you're going to first borrow against what can be your most affordable, efficient, cost of capital, which is usually secured asset lending, right? Just like any of us would borrow against our home, right? As collateral, you get a better rate than like an unsecured loan, right? And then second, on top of that, you'll see people tap unsecured markets or just kind of general corporate debt. Even that, while not tied to the assets, it kind of is, right? Because they're looking at, hey, okay, if the secured lenders have got 65% LTV and I feel good about these values and I'm next in line, even though I'm not kind of directly secured by that, I kind of have that there as the residual value. So really, and same with an equity investor, they'll say, okay, listen, I'm thinking about paying X for this company based on multiple of EBITDA, return on cash flow, kind of all the different valuation metrics. But then they're also kind of cross-referencing saying, hey, listen, there's a bunch of kind of embedded value in this fleet alone. And it's just another thing to like triangulate around and help, and help feel comfortable with. Now, the other side of that is those that kind of live in an asset light model, whether it's a management company or, a business that kind of leases their aircraft or has some sort of tie up with underlying owners. Like that doesn't mean those companies are uninvestable by any means, because obviously the other side of that coin is like they don't have to put the cash flow out in the same way or take that risk and all the debt, to do it. And they kind of operate on an asset light mode. Either of those can work from an investment standpoint. It just depends. Honestly, at the end of the day, it comes down to the management team, the relative position of those businesses. Like there's a place for all of that.
Do the asset light providers have to be larger scale to attract institutional investor? Like I think about, the companies that have largely managed fleets and, wanting to raise institutional capital versus I have my own fleet, right? So we've talked a couple times about Jesse's exit, right? In today's world, as a number of aircraft would not be necessarily considered a scale player if it was all managed and leased, right? It would be a very small company. Like, how do you think about scale when it comes to these asset light companies as opposed to I own and operate my own fleet? How does scale play into that?
I honestly, I think so from my seat, where typically like our typical M&A deal, like if you just look at Jefferies, right? Our average M&A deal is probably $600 or $700 million of enterprise value, but that is wildly skewed because, as I always say to people, our practice in New York for Jefferies is really only focused on commercial aerospace and business aviation. So like we're very narrow in what we do, meaning I have a whole nother set of partners, who do defense and government and space. So it's another difference about Jefferies is there's multiple, me's, I run the group, but there's multiple me's that are focused in other areas. So we are like in one little area. So therefore we're doing deals and transactions all up and down the size range. And we just prefer to be deep versus wide. And I think it works out well because oftentimes the people buying or investing at the bigger end are also our clients. And it just sort of helps connect the dots. But I would say scale for what we see in businesses that we work with, almost regardless of asset light or heavy, there is a certain like premium to scale, especially if you're trying to attract like traditional private equity. Public markets is a whole different thing. We can talk about that. That requires public debt and public equity require an increasingly large scale unless you're doing something like a SPAC deal or something like that. But like a traditional IPO, you need to be in the hundreds of millions of EBITDA and up, and enterprise's value kind of up into the billions to really kind of make it work. But in the private equity world, I think regardless of business model, if you are, how you define scale, probably you can start like over 10 million of EBITDA plus. Like there starts to be a pretty wide, especially if you're in one of those, what did you call it? The shovel business, like the industrial, like if you're in more of the
like picks and shovels, like MRO, FBO
yeah.
software or something like that.
There you could have, 5 million, 4 million, 3 million, 2 million. But I think for the charter operators, because of what we said earlier, there has been this sort of like flight to quality and flight to scale theme going on in our industry. And that's, I think, seen on Wall Street, where people are going to be a little more careful about like really taking investment in a smaller player unless they have a very defined niche or a very, specific purpose for which they're taking on investment, whether it's to facilitate a merger or to go on an M&A kind of spree or what have you.
Yeah, well, and I think is the world of the SPAC and excitement about taking over America, or whatever it is. I mean, I feel like that's not as exciting, or at least at the moment, not as enticing to investors than it was, 5 years ago.
Yeah, there's a pretty for like emerging business models, disruptive business models. I'm speaking purely within aviation. There's kind of like there's a pretty big risk off on that in general, and part of it is just like there's so many companies trying to go public. The M&A markets are so hot at the moment. The last couple of weeks have been obviously a little disjointed, but frankly, everything is kind of still, for the most part, pushing forward. But I would say there are so many opportunities out there for full-on acquisitions, for new IPOs coming to market, for debt issuances. And remember, we're in a slightly higher interest rate environment than we were during that SPAC craze, where there was no risk-free return anywhere else. So people kind of leaned out on the risk curve. Like that's not the case anymore. And so I think for our world, if you look at most investors, they're going to much prefer backing, even if it means at a, higher premium, higher multiple, whatever, backing the sort of bigger, more established players and brands. And that applies to charter, that applies to maintenance, it applies to, FBOs as well.
So if you think like on that point, is there an opportunity for like a lower level roll up? Like, could you go SPAC together 15 small charter operators and kind of rebrand? Or would you say that it's more the larger operators, like capital is going to gravitate more towards, call it the Wheels Up, the Vistas, who can opportunistically pick off the people that it makes sense, but they don't have to. They could just grow organically.
I think it depends. And I'd be curious to your guys' take on this too. So one thing that I observed, and it goes back to what we were talking about earlier. So I think for the people saying, hey, we want to be the big brands and sort of retail, meaning direct to consumer, business owner, whomever, I think there's a pretty strong belief now that you've got, obviously you've got NetJets, and then if this from a US perspective, largely, you got NetJets, you've got the Flex family of brands, right, which have, grown rapidly over the last decade. You've got Vista that has done the same. You've got Wheels Up that has become, even though they're in a mode of get smaller first to get bigger, but that's because they're transforming their entire business model, and the level of accomplishment they've had since the whole management changeover in the Delta investment is actually, is quite impressive, right? They've refleeted everything, rebranded, et cetera. You've got your kind of handful of players, and then you have, the very long established sort of players like your Plane Senses of the world that have been out there for a long time and they're end of the market. Like, I think if you came and said, hey, we want to become the new retail player, and I don't know if that's a perfectly right word for what I'm calling these guys, the branded operators, you're probably going to get some skepticism, especially as you pointed out earlier. There's just been such a flock to, kind of the big, well-capitalized, kind of larger aircraft, fractional players. But what I find interesting, and Jess, you would be uniquely qualified to speak to this, is one thing that happened, though, is any of those players, right, still rely from time to time or more significantly on, your kind of more private label B2B subcharter, whatever the correct term people like to use. And that space got really hollowed out for a period of time, yourself included, where they actually, the players that I mean, I think we did 5 of those on the buy side for Wheels Up alone during that time. And obviously Flex did a couple and Vista did 3 or 4, where a lot of those B2B white label people kind of went away because they got consumed into the whatever customer was in most need of it. So actually that space has become quite open in a lot of ways. By my eye, by the Wall Street eye, you don't have that big player.
Yeah, no, I think the world is waiting for more of those 10 to 20 airplane operators, and they're rebuilding. There are a couple out there that are on their way. But like you said, I think it's at this point, those are kind of the organic growers, the ones who make the right choices, who control costs, have good margins. That's the one, eventually who's going to get, rolled up in a good way for everybody, and not just like a
exactly. And so what my investors, if we had a really promising CEO, founder, entrepreneur who had one of these companies and, maybe had its fleet and was building and was doing really good, kind of flying for whoever, for your NetJets or your Flexes of the world, and making a nice kind of, nice business kind of in a B2B way. And they wanted to take on an investor to go consolidate more of the space. I mean, that's where it really gets down to the quality of the team and the thesis, because any one of my, private equity clients or asset managers would say, okay, this sounds interesting. You management team, tell me, what is the benefit of rolling all this up, and how do you handle the certificate complexity and the fleet commonality, and what does it do? And if there's a good answer to that and a demonstrated path, that becomes very investable, right? Does that all make sense? Right?
And that's the hard part is when you have a nice, clean, consistent fleet that's running with one certificate, it's running like a well-oiled machine. It's great, and then when you try to consolidate and push them together, that's where a lot of the hard part comes in.
Well, right. And public investors, and a lot of people have seen this very publicly with the airlines, right? Every time the airlines try to merge, you get certificates and unions and this and that and fleet commonality issues. And, I mean, that was the hard part that Wheels Up had to manage when they were doing their, kind of hyper acquisition. They would have assets sitting there ready to go, but pilots from a different certificate sitting there, and they couldn't get in the, that type of stuff takes time to work through. But I actually find that part of the market maybe potentially interesting for, new investment or private equity entrants to kind of, create a really big mid-size, B2B provider, if you will.
I think there's an interesting trend in that comment, in that you have a few operators who almost seem to be the discards is the wrong word, but I'm trying to come up, Baker just bought a bunch of old FlexJet Challenger 300s. You have Bel Air, which is now rebranded, who got a lot of old Vista Citation 10s. And you kind of have
the XO fleet.
Yeah, the XO fleet. There's the Wheels Up King Air fleet is now floating around there to a couple of smaller operators. So you have almost, as the big players are consolidating or changing over their fleet, it's almost like there's this spill down, same aircraft, right? The airplane itself is moving into a different operator. But I would not say that, at least to my knowledge, that I know of anybody who's kind of climbing up from the bottom. They're not buying, there's few, right? There might be a couple that are organically stacking new or newer aircraft in order to be able to serve that supplemental lift for the large branded operators.
I would add in too Contour, right? Contour did a big deal with Wheels Up on some of their old fleet too. And in some of those deals that I have knowledge of, that also comes back with contracted flying, at least for a moment, right? So those groups acquire the sort of the excess fleet, in an exchange, because, dropping all that out of your fleet when your Wheels or Vista or Flex, there's a period of time, or maybe an extended period of time, where you're going to still need and want that lift. They're just trying to get their own kind of asset management strategy intact. And that's where you can create a real win-win versus a Contour or a Bel Air kind of saying, hey, I'm going to take these aircraft and then go try to be the big retail provider where my name's on all these commercials and this and that. I think they found, that there's an ecosystem that exists. It works in the commercial airline world, as well, where you can do that, and you can make, you have less, kind of retail risk, and you're able to, take flights and missions as, at a price that kind of earns you a return, and also works for it. But yeah, I don't think you're going to see, I think is what you're saying, Preston, like you're not going to see, or we have not seen someone make a big order with Textron to support that model, or with Gulfstream.
Yeah,
right?
exactly.
Like,
Exactly.
kinda,
Like you don't have the B2B charter guys going out. Like, okay, our sponsor, AB Jets, they bought 3 Challenger 3500s. That's 3 aircraft. That's not 30. Right. And so like it's not like, hey, here's our long-term scale play to be the non-branded operator. Like just, I know that Grandview had a lot of NetJets contracts, right? They fit the certain criteria that allowed for NetJets to go off fleet. Whereas I don't see that in the market. I wouldn't say that, well, yeah, let me point right there. That's the person who provides all the supplemental lift to these operators.
Yeah. And I think that's the opportunity. And you've kind of named a bunch of the, right? Your, like you say, your Bakers, your Contours, because Fly Exclusive, right? Jim, he's gone. I mean, that's kind of how, at least when I met him, that's what they were doing. And then, they saw a pocket and opportunity and sort of, developed their own kind of brand. And now they're off, kind of competing more in that bigger space. That was a big hole too. So like between acquisitions, changes in strategies, like Fly Exclusive and others, like, it's an interesting model. So like, my investors, I don't think any of that's ready for the public market. So you could put that aside, but like from a private equity or growth equity standpoint or structured equity, however you do it, if it's the right team and strategy and the economics sort of work, like that's absolutely backable for, to get behind a team. The key question though, on the operator side is what's the end game for a lot of these? And that's been like the big, question as this whole sector plays out. Like, what's the ultimate end game for some of these operators? Right.
Well, and
like,
the way that I looked at it, back when we were building was like, let's be the wholesale, white-tailed fleet for these big companies while we build the retail side, because you can't really build the retail if you don't have the scale. Your customer doesn't live
and it's hard to
just
get
New York or
scale
Florida.
just starting day one, selling to the
Right.
consumer,
Like,
right?
yeah, so you're going to have to do that wholesale side of it. But also, like, I just caution those listening, like, it's great to get into these deals, but there's also been cases where you have too many eggs in one basket. So you just need to make sure you're kind of balancing who all your and we've seen this with airlines too, American Eagle, whoever.
Look at the regional airline space, like,
Right.
the SkyWest. I mean, for every SkyWest, which is a very flourishing, well-capitalized public company, there are a lot of those that did not end particularly well because they got themselves too tied to United, American, whoever. And then when they shift their strategy or go to a different provider, you're kind of in a tough spot. But I would say even for the big retail guys, right? Like, I mean, obviously NetJets kind of lives, if this whole thing would be very different if NetJets had, who's been big and large and the name brand forever, was a public company. I bet you'd probably see at least 2 or 3 more other public companies, because the way the public markets work, they tend to like want to look at another perfect comp that's kind of already out there in the public space, and then they can make their relative assessments about valuation. The tricky thing is for our space is we don't have, other than standard aero, and that itself is still largely, it's got a big commercial aero story to it, right? I mean, they're really into like large engines now, in addition to what they do in our world. But you don't have really many comps, even the FBO space, right? So what's interesting now is you have very large institutional capital involved in Flex, involved in Vista. Obviously, you have public money, and then strategic investment in Wheels Up by Delta, and then the 2 huge FBO chains, have giant name brand institutional investors behind them. Great assets, great trajectory. I mean, these are all of these companies are approaching $10 billion and over, right? I mean, these are huge companies. But none of them have gone public yet, at least as a pure play, because even Signature lived inside of BBA, which was sort of this odd conglomerate over in the UK listing. And then Atlantic was owned by Macquarie Infrastructure that had power plants and natural gas. I mean, it was also, there's never been like a pure play asset. And so that's going to be the interesting thing, because when these companies get to this size, you're either kind of constantly taking on growth or minority investors, or eventually you're going to go public. And that'll be really interesting, because then it'll finally set like a real public valuation on certain of these sectors, right? We know very clearly what the private markets look at, but the public markets have yet to be tested.
That's
So
a
we'll
great
see. We'll see who gets
transition.
there first.
Well, I just wanted to bring up, we want to have a conversation about EBITDA.
I was about to
'Cause
say the
About
exact same
EBITDA.
thing.
yeah.
And EBITDAR. Nick,
And
I need you to
EBITDAR.
explain EBITDAR and why it's a metric anybody cares about, because I've yet to have anybody really explain it to me why.
Listen, all it really is at the end of the day is people trying to normalize between different business models of ownership, right? Because if you're an asset heavy company, let's say you're a charter company and you own the vast majority of your assets. Okay. Earnings before interest, taxes, depreciation, and amortization doesn't capture either the depreciation that comes from the assets, which of course is a financial non-cash metric. It also doesn't capture the interest cost associated with likely financing such a large fleet. And of course, it doesn't capture at least the equity portion of the CapEx required to, maintain and or grow that fleet. So if you own, $4, 5, $6 billion of aircraft assets and you're looking at EBITDA, you're not getting the full picture. On the other hand, if you're a very large operator that uses operating leases, that's flowing through your income statement as rent and therefore is. And so if you're trying to compare those two models, you're going to get to kind of apples and oranges. So I don't think I view this as any investor or ourselves when we're assessing a situation, we very quickly normalize for that. And so EBITDAR, just like EBITDA is a shorthand kind of way to look at operational cash flow. It's not perfect, but it kind of works for most situations. EBITDAR is kind of meant to be a way to adjust for that to some extent. But at the end of the day, investors are really looking down to what's the ultimate, cash flow generation? What are the return on the assets? So, to me, when I look at someone that is asset heavy, I'm looking below and I'm saying, because depreciation is just a fixed, that's kind of an accounting thing. So really what you're looking at is, okay, how much below the line, as we call it in our industry, and EBITDA needs to go back in to maintain? Because sometimes another tricky thing that you didn't ask about, but now I'll tell you about, is some operators have different accounting policies for maintenance, right?
Mm-hmm.
And so
Engine
sometimes it's
programs.
flowing through the income statement. Sometimes they're actually capitalizing engine overhauls or cabin restorations or other things. And you wouldn't see that up here. It's down here. And so what we usually look at is we'll say, okay, take EBITDA as a starting point. But then if you've got a really big kind of asset intensity, what amount of capital needs to go into just maintaining the fleet, meaning your capitalized maintenance expenses? Then there's sort of the replacement angle of it. Then there's sort of, well, then what do you need for growth? And that sort of kind of steps in for the DA part, right? Because DA is accounting. I want to look at actually, what kind of cash is going in there. And then that's going to be able to give you a better apples to apples view of someone who's just having, kind of operating leases. So we preach, when we prep, either when we're assessing a situation to see if and how we could help, or even when we're out in front of investors, we're very big on sort of transparency and giving people access to the information they need to kind of come at it their own way, because everyone has their own different way of looking at it and things they like to think about. So we try to be it never makes any sense when you're running a process, in my opinion, where you sort of put something on a page at a high level that looks really snazzy. You get a bunch of people interested and maybe bidding, depending on if you're running an auction situation, they're bidding the book as you speak. And then they get to the next round, you make certain decisions about who you want to spend more time with, and they haven't really seen the details they need. And then you just set yourself up for, I don't even want to call it a retrade, because that's not fair, because they haven't seen the information. But we're very information forward, unless there's a competitive, something where you got to be a little guarded. But let's just say there's no competitive concern. Lay that stuff out there, allow people to kind of have the pieces of the puzzle they need in transparency so that they can do their own analysis. Because listen, I always say to clients, we may not like the answer, but I'd rather know the actual answer rather than, someone kind of putting a number out there that's just going to disappoint us later. Because you could then very easily leave someone else behind who maybe actually had a more constructive view, and you were just kind of making decisions. So we try to front load access to the different kind of levels around that. So again, EBITDA is really just meant, none of these are GAAP figures, EBITDA,
Mm-hmm.
right? These are all kind of investment
But
world shorthand. And
it
then
really matters for, I mean, these fleets, because if investors don't understand where their assets are on the depreciation curve, I mean, or the expense costs, like you really need to be educated on that if you're looking at these firms.
exactly right. And that's why kind of laying out very clearly like what you're spending below the line to just maintain them, right? Because there's a trade-off between asset acquisition costs and operational costs, right? And there's somewhere on the curve that is optimal. And frankly, that may be different for different business models. Like,
Mhm.
Acquiring 5 to 10 year old fleet, like those could still be put into fraction. If it's got like, I'm a big, I worked at Delta. I'm a big Delta fan as a customer. Like I know as sort of an industry person, I'll walk on and I know that plane's 25 years old, but like the cabin looks good, the Wi-Fi works, people have a smile and they leave,
Mhm.
the flights leave on time. I'm good, right? I'd rather
Yeah.
that than a brand new plane that, looks terrible and doesn't work. So like you can buy down the curve and kind of have a, better return than otherwise. But I just think you really got to kind of lay it out very clearly and give people the tools they need to make their own decisions. You really can't force valuation down people. There's kind of set comps and every deal has it. And that's why we sit in a fortunate position with clients or buyers is like, we've often worked on the past transactions. So some people will say to us like, well, why did that trade for 14 times when I'm at here or this? And I was like, well, either like the forward numbers look like this, or you didn't see the CapEx, or there was a big contract. There's always, these aren't like publicly traded stock prices where the price is the price and it's very transparent. There's a lot of stuff that goes
And
into these,
and
even
sometimes it's how motivated is someone to close? Sometimes,
well,
like
yeah,
that's yeah.
no, exactly right. And so there's a story behind every, multiples as advertised is really just is just an output of the analysis that people, it's just a common way for people to say, what was the price? What was the earnings at the time? That was the multiple, but that's not how people are getting to their valuations. They're thinking through how much do I need to put into this fleet? How complicated would integration be? What are the commercial synergies? Like all that stuff is going into their calculus and it just ends up expressed as a multiple, which just becomes an easy way for all of us to talk about deals. And things with assets are more complicated. The other thing that's made it a little easier now is, with all the accounting changes, lease obligations are more now like on the balance sheet, and there's a proxy for them as debt, right? Because that's the other unfair thing. Like if you don't have all this liability before on your balance sheet, now there's a way to kind of reflect that, which makes the EBITDA thing a little less relevant. But
Interesting.
hopefully that helps.
How about cumulative losses, Nick? There's a lot of the public market comps that are out there, and I'm not going to name specifics because we don't want to get you in compliance trouble. But a lot of it feels like every earnings report that I read has a cumulative loss that feels challenging to overcome, right? So it's like you're going to have to be in operation for a long time or get a lot more customers to overcome your cumulative loss. How does cumulative loss play into, that's probably more of a public market, but I would imagine that there's cumulative losses in the private market too. Like how should we as, industry people be thinking of cumulative loss?
Yeah, so yes. And then there's sort of financial losses and then there's tax losses where actually in some cases cumulative losses are seen as an asset, right? Because you've got a model that, there's a significant tax benefit to those who own assets for the most part. And obviously this latest tax change kind of further magnified that, or at least, rendered them permanent for the time being anyway. So to be perfectly candid, they probably don't get the level of attention you might think. Investors are typically very focused on the forward of the business and like what even debt investors, right? They're going to look at effectively EBITDA less CapEx, less working capital to really. Debt investors basically just want to know, are we going to be able to get paid back? Because they generally have no upside in the business. All they want to do is make sure they get paid back, right? So they're going to look at the actual earnings, forget like the depreciation factors and other things that create, kind of accounting or book losses. They're looking one way. And then other investors, they're kind of looking at, okay, where are we today and where is this going, from an earnings, from an EBITDA, from a competitive positioning growth, maybe you'll kind of look into it to the extent that there are tax attributes that could affect value for a deal, positive or negative. I've seen that where certain NOLs and other kind of tax driven losses actually have a discrete value to themselves, that kind of get negotiated as part of the valuation consideration. But Probably not as much as you would think on the balance sheet side, at least for private equity investors and to some extent public investors.
Interesting. I learned something new today. Because
Yeah.
in my kind of finite mind, I'm like, well, I have this big, I have not made money for this long and it's accumulated this much. I have to get above zero to like be making money, if you will.
Yeah. I mean, it's all in the past. You're probably going a step further than, most do, which, maybe we all should. Yeah, it doesn't get the level of, attention you might think. Right. Cause you go look at that statement of shareholder equity or whatever you have, you see these big kind of negative numbers, but I think a lot of that's viewed as accounting loss, if you will.
Interesting. The other sticky topic that I want to get to before we, run out of time, there's like so many things we want to ask. But eVTOLs, how are investors looking at that space right now? What's going on lately?
Yeah. So I think the eVTOL space, during kind of the, COVID through kind of boom 21, 22 days, we saw a lot of them get public either directly or via SPAC deals. But, we worked on a couple of them, including the Eve transaction, which was the spin out of Embraer. A lot of them are out there that, they have a public value kind of stated on there. Frankly, none of them really have revenue, right? So every quarterly update is basically just it's basically progress on certification and then cash burn and liquidity and then like other commercial agreements and such. Like there's not much there. Today's world, you can so if you're a public eVTOL operator, for some you can you can still access the public markets, whether it's with a traditional follow-on offering or there's a product that's become quite popular called the ATM, which is the at the market, which is effectively, I'd almost call it like an equity revolver where you can kind of dribble in every, day of trading. You can kind of raise capital kind of in the.
You can go to the ATM, if you will. If you need
can
more,
go to the ATM.
The ATM, you put your pin in.
Yep.
That's not lost on me.
And the higher your share trade, the higher your share volume traded, the more you can raise. It's kind of looked at as like a percentage of how much is out there, how much you can kind of dribble in. So it's become like actually a fairly, not just for eVTOLs or more emerging companies, that's become a really big product in just sort of Wall Street generally. It's a really can be really efficient for public companies. Private investment into that space, whether it's pipes into the, which is a private investment into a public company, or other capital raising is a little bit difficult right now. Like everyone knows where the sector is going, and I do expect it to be a huge part of, society, right? I mean, there's some real, very clear use cases and some interesting things that could change a lot for the aviation industry. But then you're just getting into picking the winners. Back to one of you said it earlier about the charter. Like it's not exactly where a lot of investors want to be because it's really difficult to tell. You're going to have to see some consolidation. You've seen a couple of them kind of go away or sell their IP or assets or, but it's like from a private equity standpoint, like where the mass majority of like MRO and distribution and, more, pick and shovel, is that what we're calling it? Pick and shovel guys, picks and shovels. That world is not really open to for the eVTOLs. It's too speculative. And like, again, right now you got interest rates higher than where they were, and you've just got a lot of other investable opportunities. So like people would much rather invest in the IPO of Standard Aero, right? A real company with significant earnings growth and market presence than kind of picking a winner, on one of these names. So a lot of the investment we've seen in that space have either been further follow-on investment from the existing investors, or sometimes like a strategic that has a angle into that, like, hey, I'm going to be the engine manufacturer for this type and I'm going to make an investment alongside it. But it's pretty limited other than that.
So regardless of business model and what people are working on, I think a lot of people that listen to the show are entrepreneurs. What do they need to be doing? They're probably not thinking of, because they're busy running the operation. As someone who sees a lot of deals all the time, like what are the spaces they need to pay attention to?
So this sector in particular has a very high percentage of real, material players in the space that are still founder-led or entrepreneur-led, and in many cases in a very kind of public way, meaning like they're kind of the faces of their company, right? Like we see this way more in this than you would ever see in the defense supply chain or even commercial aerospace. A lot of these companies are just older, bigger, public, they've been through multiple kind of iterations. We have a very heavy founder content here. And I would say even more so in the charter fractional management type of space. So one of the things there is like the most you can do to separate, if you're going to look to actually sell or sell control or take on a very significant, meaningful kind of equity investor, you're going to want to pretty quickly show that the dependency on that one person is not going to make or break the outcome. Because no matter what, even if someone bought 80% or 90% of your company and you rolled in, yes, they own it and control it economically and at the board level, but they can't run the company. They're still backing management. So one of the really important things is like that depth of the team or a very clear transition path, or just showing, hey, listen, yes, I'm leading the strategic direction, but the company kind of runs itself. I'm not the one that knows personally every single customer and supplier, to where if I walked away, that would be at risk. That's the biggest risk when you have a founder-led business. And then the other thing is just extracting them from the business eventually. That's like the interesting thing that makes, I think it's really why you haven't seen some very IPO-able companies not actually go public, or saleable companies that have not sold in a full change of control way, like a Westar, deals like that. And why maybe you also haven't seen certain strategic combinations that could make a ton of sense for the industry and for everyone, because you've got founders who just, their lives, it becomes completely interchangeable, right? Their lives, their business, it's all intertwined. They love it. Like, clearly a lot of these people don't need money anymore, but they just do it because that's what they do and that's what they know. So like when you're ready, you got to make sure you've had time to work through that, or at least have a plan to work through that, so the investors know, especially as you start kind of aging on up. The other thing I would say is I would highly recommend engaging earlier than sort of, I'm ready to run a process and now I'm going to go kind of interview a bunch of investment banks. Like, in many cases, we work with companies for free, right? We only get paid when deals happen, but we spend a lot of time thinking through, working with, reviewing information, giving advice about, hey, you should think about positioning this, or hey, this financial thing is going to be a real issue. You're going to want to work, like that type of stuff, because if you've decided this is your moment to sell, that's just going to elongate the kind of prep process, or just put risk to the deal if you don't kind of have people involved earlier, at least in an informal way. And then obviously cleaning up, a lot of people, if you're running a business for yourself, like your financials can have a lot of things in it that are optimizing for your personal situation. And that's fine. That's totally understood and accepted, but like getting ahead of all that, dude. But the biggest thing is the bench and the continuity. You do not want to be seen. I know it's counterintuitive to a lot of people that are like hard charging entrepreneurs. They want to be seen as the one that, I'm the one who makes everything happen. But that's actually a negative when you're thinking about doing something like this.
All right, Nick, one last question that I get a lot from people in the industry, kind of, cocktail conversations, is Bond getting a huge raise from KKR. Is there room for another scale fractional player that's maybe premium luxury? Like, how do you view how much more room there is kind of in the fractional space for multiple brands?
Yeah, well, I mean, so I know Sergey and Bill very well. I've worked with each of them in the past. Think the world of those guys, and they've obviously been very successful in their own right. They have picked an aircraft OEM that has proven to be very popular amongst the fractional and frankly the Part 91 space there. And there's some proven success to their track records, right? In the past, and I think that we did not work on that transaction at all, but I'm very familiar with the situation and know the principles very well. The track record of prior success with KKR, with Jet Edge, so with Bill, when you find success, with someone, and it's someone you've been in business with before, it makes it a heck of a lot easier to go back and kind of do it again. So I think that helped them significantly. And if you think back to what we were talking about earlier, this seems to be where I'm a hockey guy, so like where the puck is going right now is to more of this fractional. It's part the tax benefits, part the service, and the model, seems to work well and appeal to investors. And if you're hitting the ultimate ultra kind of luxury tip of the spear, as I understand about their kind of plan. It's going to be, even more discerning and bespoke from like a branding and service standpoint. That's where you have literally the people that fly above the weather, right? So, if that service is there and they can execute operationally in customer service, I would say, yeah. And I don't think that's a zero-sum game, where the pie then gets smaller for any of the other players. I think a different offering in that space. I think there's plenty of room, and I'm excited to see what those guys can do.
Me too. I think too, I look at, just the shadow that NetJets cast across the whole industry. If you look at their activity versus every single other operator, it's unbelievably smaller. So I tend to agree that there is room for more and bigger, and to keep challenging the traditionals.
Yeah, no, I think it's good for the industry. It spurs competition and innovation, and there's plenty of capital out there, as these guys found, with basically a sheet of paper, right? That's happened a few times now, where people who are proven executives in the space have sort of an idea or concept. Like, the market will be there, and there's a lot of creative ways to do that and to raise capital. That's one of the best things that came out of COVID. Where, remember, we were talking earlier about the dislocation of, no one could find normal for like a full sale. Like, it was like, sellers were thinking here, buyers were thinking here. What kind of created itself out of that was all these different structured, we could do minority, we can do structured off your assets, we can do convertibles, we can do prefs, there's so much technology now, and all these big financial institutes like KKR, perfect example. They're known as a buyout shop historically. Like, they were like the original like private equity LBO guys, but they're basically a giant asset manager. They have, they manage insurance money, they have debt, they have infrastructure, they have regular private equity. The availability of sort of capital, you almost, like, what I always tell our clients when we're doing something other than like just a broad auction or IPO is like, let's just start explaining the company and what you're looking to achieve, your objectives, whether that's for the business or you personally or your shareholders. And then let's not go out with like a term sheet of this is how we're doing it. Describe the situation, and then let each investor try to solve it in their own way. And if anything, because these investors all have their playbooks they go to. So like, obviously in that situation, they had run this playbook once before, right? At least with Bill's private company. So then they kind of know what they go back to, and everything kind of works efficiently. Like, let the investors kind of go to their ways they're used to working or have found success, and propose something to you. And the beauty is, then we get to sit back. We have all the cards of how people are basically offering to solve our problem, and we can either pick one or take the best ideas from other people and try to get it into something, versus being overly prescriptive on like how you want the capital to come in. There's way more creativity out there now, which is just a positive for everyone. It's good for the investors, and it's good for the clients, your listeners.
Sweet. Well, Nick, we have really appreciated you being on the podcast. This was a fascinating conversation. Is there anything else that you want to leave our listeners with? Just like one little more, if you have one more nugget of wisdom, or like, blow some minds right here before the end of the podcast.
No, I think I kind of left it all out on the field. We always, we appreciate it very much, being involved in this. And Jess, I've known you for a long time, and I love what you guys are doing. Our industry needed something like this, from a modern day communication standpoint. Thank you. And like I said, we always welcome meeting, new companies, new executives, or new investors, well ahead of anything actually going on. We live in a very small world, so look forward to meeting more people and helping where we can.
Awesome. Well, thanks, Nick. To wrap us up, that has been an awesome episode of the VIP Seat podcast. If you liked this one, we need you to leave us a 5-star review and say how much you loved having Nick on the podcast, that it was awesome. Leave us comments on YouTube. Share it with everybody you know in business aviation, whether they are someone who works in management, someone in finance, someone who is in acquisitions. This is a playbook for setting up your company for private equity rounds, or raising capital, or selling your company. This is a great place to do it. Go subscribe to the newsletter at thevipseat.com. For my awesome co-host, Jessie Nayor, and our great guest this week, Nick Fazioli. Thank you, AB Jets, for sponsoring this week's episode of the podcast, and we will see you all next week.